When I checked the news alert early morning, I was genuinely confused. The Senate passed a shutdown-ending bill, but why were market reactions so wildly divergent? Some stocks crashed nearly 9%, while others surged over 8%. The Senate passed the budget bill 60-40 after 8 Democratic senators voted in favor. The bill includes funding for most federal agencies through January 2026. Reinstatement of furloughed federal workers, back pay for those on unpaid leave, and veterans programs. On this news alone, the S&P 500 rose 1.5% and the Nasdaq jumped 2.3%. But here's the critical point: the shutdown isn't actually over yet. The House vote is still pending. The market has already priced in a shutdown resolution based solely on Senate passage. J.P. Morgan analyst Michael Brown said the market reaction is rational as funding restoration removes growth headwinds, but is that really the case? The FAA ordered 40 major U.S. airports to reduce flight operations. They're trying to ease system strain because air traffic controllers aren't getting paid. The Transportation Secretary explicitly warned that if controllers don't receive pay, Thanksgiving holiday air traffic could be paralyzed. So here's the situation: the market is celebrating the shutdown ending, but problems keep erupting on the ground. United Airlines fell 1.4%, Delta dropped 0.5%. On top of this, after a UPS cargo plane explosion, Boeing recommended temporarily grounding that aircraft model. UPS fell 3.0%, FedEx dropped 2.9%. When freight transport gets disrupted, it impacts retail sales. With Thanksgiving approaching, if logistics chaos hits, Black Friday sales could take a beating. Yet the market seems unconcerned about this. AI tech stocks are living in a completely different world. NVIDIA rose 5.79% on continued strong AI chip demand forecasts. Palantir skyrocketed 8.81%. Microsoft ended its 8-day losing streak, rising 1.85%. The most intriguing was CoreWeave's earnings. Q3 revenue hit $1.37 billion, up 133.7% year-over-year, beating market expectations by 6.1%. Revenue backlog reached $55.6 billion, with $25 billion added in Q3 alone, nearly 4x the beginning of the year. They signed contracts worth up to $14.2 billion with Meta and expanded their OpenAI partnership to a total of $22.4 billion. They're investing a total of $6 billion building a 100 megawatts data center in Pennsylvania. They also announced an additional $2.5 billion investment commitment in the UK. Yet after hours, the stock fell 5.9%. Why drop on strong earnings? This year's capital expenditure is $14 billion, but next year it'll more than double. Investors are thinking, aren't they spending too much money? Here's the key point: AI infrastructure investment is exploding, but actual profit generation comes later. TSMC reportedly received a request from NVIDIA to increase 3 nanometers wafer production from 100,000 to 110,000 per month to 160,000, a 50% increase. Demand is incredibly strong, but investment scale is astronomical. This raises the question: can AI companies actually recoup all this money they're pouring in? The market is currently suspending judgment on this question. The mood is invest first, ask questions later. Healthcare was in complete chaos. The Senate bill excluded ACA Obamacare subsidy extension. Instead, it guarantees a vote on ACA subsidy extension by mid-December, but market expectations aren't high. Centene fell 9.2%. Molina Healthcare dropped 7.4%. Humana declined 5.7%. Elevance Health fell 4.5%. Without ACA subsidies, insurance premiums for low and middle income families will spike dramatically, inevitably reducing enrollees. Insurers face a dilemma: if enrollment drops, they need to charge remaining customers more, which causes more people to leave. A vicious cycle begins. United Health Group's CFO recently said at a conference, We're assuming no subsidy extension and forecasting deteriorating profitability for next year's ACA business, and this is becoming reality. Interest rates can't be ignored either. The 10-year Treasury yield rose 2.7 BP to 4.12%, not a huge move. Shutdown-ending expectations reduced safe haven demand somewhat. What's interesting is the New York Fed's estimated term premium. It's currently 0.61%, down from 0.91% in mid-October. A declining term premium means the additional return required for holding long-term treasuries is shrinking, a signal that fiscal anxiety is easing. Possibilities are emerging for breaking down the long-term uptrend line formed over 5 years. There's a forecast that rates could fall to around 3.6%, but several conditions are needed. First, when the Fed's QT ends, they'll purchase zero-coupon treasuries with MBS redemption proceeds. Second, banking deregulation will increase treasury buying power, creating private QE. Third, when court rulings on tariffs come in Q1 next year, inflation concerns will diminish. But here's the trap: government economic indicators aren't being released because of the shutdown. We're making interest rate forecasts without knowing exactly how inflation is moving. When data does come out, if the actual inflation path differs from expectations, rates could adjust sharply. White House NEC Chair Kevin Hassett warned prolonged shutdown could potentially cause Q4 negative growth, and this isn't a joke. The University of Michigan Consumer Sentiment Index fell to its lowest level in 3 years. People are anxious. Tesla's story is interesting too. The stock rose 3.7% after Elon Musk said we can build a massive AI inference network with Tesla vehicles and pay vehicle owners $100 to $200 monthly. It's the idea of cars becoming AI computing resources, but feasibility remains uncertain. We need to look at China too. October CPI rebounded to 0.2%, and PPI narrowed its decline to -2.1%. It looks like deflationary pressure is easing. But look closer and the story changes. Core CPI gains are thanks to the trade in appliance replacement subsidy policy. The government threw money to boost durable goods consumption. This policy cycle has run about 2 years, and there seems little room for further gains. PPI improvement isn't from the anti-involution price war crackdown policy either. Steel prices keep falling. Rather, lithium carbonate and precious metals like gold and silver drove the PPI decline narrowing. Lithium carbonate prices rose as AI infrastructure expansion increased power grid demand. Most concerning are exports. October exports were -1.1%, but market consensus was 2.9%, completely off the mark. The Statistics Bureau's manufacturing PMI also came in at 49.0, below the expected 49.6. It's a clear signal of weakening external demand. If the Chinese government doesn't succeed in domestic stimulus, deflationary pressure will return. The market is watching whether an additional NPC Standing Committee meeting will be held before year-end, and what fiscal policies will emerge from December's Central Economic Work Conference. Bottom-line markets are now focused exclusively on AI investment stories while ignoring real economy weakness. Stocks rose on shutdown-ending expectations, but they're ignoring air traffic disruption warnings and logistics chaos concerns. AI tech stocks jump 8% while transport stocks fall 3% and healthcare insurers crash 9%. These stark differences show the market is selectively embracing optimism. Rates look set to fall, but forecasts were made during a data vacuum, so if the actual inflation path differs later, sharp adjustments could follow. China's inflation rebound is only surface improvement, while the export collapse directly shows weakening global demand. Ultimately, here's what we need to watch: can the AI investment frenzy actually translate into real profits? If real economy weakness intensifies, won't AI tech stocks also take a hit? We need to keep an eye on when and how these risks the market is currently ignoring will explode.